Just so everyone knows, this meeting is being recorded and will be available afterwards.
It's always best to watch it live.
It's always best to watch it live. All right, so it is 12:30. Good afternoon.
Let's give it one more minute because more people are coming in.
You got it. Give us 1 minute and we will launch into our quick presentation today. Lots of people joining today. Give us a couple more minutes to launch. We want to make sure everybody hears what we want to, the information we want to deliver to you today. The dings are starting to slow down a little bit.
I would say at 12:32 we'll start.
Sure. You got it. You let me know, Melissa. Oh,
Too many M's on this call today.
Too many M's on this call today. It's not like we've known each other for decades.
That's okay, Joe. I know who you are.
Ha.
Okay, it seems like we've got the bulk of the people in here now.
Great, great, great. All right. So good afternoon. Today, Melissa Cohen from Ravis Mortgage and I are going to be presenting the intricacies of the 2023 loan limit increases from Fannie Mae and Freddie Mac. So before, without further ado, I'd like to announce that this presentation will be recorded today. If you have a question, please utilize the chat feature. We're going to try very hard to get to all the questions, should there be any. If we don't answer a question, we will email you back with that answer after the meeting. And this meeting will be available, webinar will be available after the meeting is completed. And we're likely to post this on our blog at CondoTek or send it out to all the participants. So thank you for joining us this afternoon. There is some big news in the mortgage market that was recently released. Not that it wasn't expected, but Fannie Mae and Freddie Mac have increased their loan limits for 2023 beginning in January. So today, Melissa Cohen and I are going to try and explain the double-edged sword theory of why this is great in so many ways, and why it may present some difficulties to condominium cooperative boards and buildings across New York City and frankly across the country. So with that being said, I'm Orest Tomaselli. I'm the president of Project Review at CondoTek. And I'm also the owner of Strategic Inspections, a company that provides reserve studies to many of the condominium developments across the United States. On this call, and is my buddy and that I've had for decades, I think at this point, Melissa Cohen, and she's my my go-to when I have a mortgage question or a question about the marketplace. Melissa and I have spent many hours together providing important industry information through several different venues, and providing webinars and providing guidance to agencies and associations and attorneys and boards and realtors. And I really value, her knowledge, and I thank her for being on this call. So thanks, Melissa.
Oh, it's my pleasure, Orest.
So let's delve right into this today. Fannie Mae and Freddie Mac announced that the loan limits are going to increase, the conforming loan limits are going to increase effective January 1st to $726,200. And for high cost areas, the loan limits are going to increase to $1,089,300. That's almost a $400,000 increase, from 2022 to 2023. And while a lot of people are thrilled that loan limits have increased, for condominium and cooperative buildings, this presents some problems. And the problems come about because of Fannie Mae and Freddie Mac's new lending guidelines, which were released earlier in 2022. And a lot of these buildings and borrowers within these buildings were enjoying, not only last year, but for years before this, the ability to get portfolio mortgage financing on jumbo loans. And the crux of the problem here is that jumbo lenders were happy to provide, and some of the big box lenders were happy to provide portfolio lending internally to borrowers that were seeking mortgages that were above the conforming loan limits. But that's not essentially true for borrowers who are seeking portfolio lending that are within the conforming loan limits. And because of
Orest,
that,
I think you should just sort of define what your definition of a portfolio lender is.
Sure. So portfolio lender is essentially, for me, a big box lender that is essentially one of the big 5 lenders in the country that will provide residential mortgage financing based upon their internal lending guidelines, and for loans that are unsaleable to Fannie Mae and or Freddie Mac, either because the loan limits exceed the conforming loan limits, or there's something that's not quite compliant about that particular building in regards to Fannie Mae or Freddie Mac lending guidelines. So Freddie Mac and Fannie Mae's guidelines now really focus on the structural, mechanical, and financial condition of condominium cooperative developments. And because of that, and because of their new guidelines, many buildings across the United States are no longer compliant with Fannie Mae or Freddie Mac's lending requirements. So what we're going to go through today is why they're not compliant, what are the options for lending in the conforming space right now, and how to get some of these buildings compliant. So what's important to understand? Again, those guideline changes that came about in early 22 really focused on the structural, mechanical, financial, and capital reserves of a building. And Fannie Mae created this unavailable list, which essentially shuts down lending in non-compliant buildings. And that list currently includes more than 1,300 condominium and cooperative developments across the United States, and it's growing every day. And once you get on that list, it's very difficult to get off that list. And that list is checked by almost every single lender in the country prior to providing borrowers with residential mortgage financing. So the point is, if you're not compliant and you end up on that unavailable list, the only sources of residential mortgage financing are outside of Fannie Mae and Freddie Mac's purview, meaning that you can't sell a loan to Fannie Mae or Freddie Mac in almost every single instance. There might be a couple of exceptions here or there with Freddie, but in most instances, you can't deliver a loan to those agencies. So you need another resource for that type of lending for buildings that are on that unavailable list. I was just sharing with Melissa a couple of minutes ago prior to this call that last week we were lucky enough to get the first building removed from Fannie Mae's unavailable list. And we did so by really focusing on the compliance of that building, completing an application for Fannie Mae through their PERS approval division, through their global approval that is essentially one of the only ways to get a building off of that Fannie Mae unavailable list. And we successfully removed the designation of unavailable for lending from that property, and now borrowers can get conforming residential mortgage financing there. We did it with a 10%, we included a reserve study. The board had set aside a 10% line item for reserve in the operating budget, but they needed a reserve study to prove that the structural components of the building were in good working order and mechanical components of the building were in good working order, and that the capital that they had set aside was enough to do the repairs in the near future. These new guidelines that were released last year really bear down on special assessments for these condo and co-op properties, and special assessments can be really problematic. Special assessments are utilized across the country to pay for mechanical and structural repairs, and Fannie Mae has said very clearly that those repairs have to be complete if you're taking the money from your special assessment. And that doesn't always happen, right? You collect the cash, then you do the repair. So these special assessments can be really problematic and limit or create an instance where these buildings are going to get put on Fannie Mae's unavailable list if they have a special assessment. So again, you need another solution for that type of lending. Deferred maintenance is an almost automatic rejection in almost every single property if large capital components haven't been repaired or maintained properly. And reserve studies have now become a key source of getting a building approved or getting past these compliance issues. So it's important to know what those 2023 guidelines did. So Melissa.
Well, we haven't even seen the 2023 guidelines quite yet.
Well, right, exactly. Or 2022 guidelines, what they did to the industry. Correct.
Right.
And now there's new
what changes are we
guidelines.
expecting will happen next year?
So there's talk of Fannie Mae changing their guidelines again, and Fannie Mae requiring, based upon certain triggers, like if a building has deferred maintenance or a building has a special assessment, that there is likely going to be a requirement for a 25% line item for reserve required to be in an operating budget. Woof. So can you imagine this? You have a normal building in New York City, let's say as example, and they're already contending with inflationary increases and increases to, oil heat costs and increases that are coming from the new, carbon reduction requirements from Local Law 97 and the repairs that they have to make to comply with that. And then all of a sudden, for them to get compliant, you also need a 25% line item for reserve. It's going to be devastating for a lot of properties, and mortgage financing is going to be hard to get in a lot of buildings, condominium and cooperative buildings in this New York City market, as an example.
But not even New York City, also, like, for example, in Florida and other marketplaces as well. And it seems to me that what Fannie and Freddie are doing is they're saying that, buildings have not been managed to their satisfaction. There have been too much deferred maintenance that have been allowed to happen from building to building because, everyone wants the next owner to have to pay for it. And now they're saying it's no more kicking the can down the curb. It's time for buildings to be responsible, to be fiscally and structurally responsible for themselves on an ongoing basis. And you can't just say, okay, well, we'll deal with it next year anymore.
Yeah, 100% right. It's time to pay the piper for a lot of these buildings. And we've seen total restructures of the financials within a lot of condominium and cooperative buildings, to your point, across the country, in order just to ensure that residential mortgage financing is going to be available for owners and purchasers in those buildings. The problem is if you don't, right? What happens if you don't comply if you're those buildings? Not only will you end up on Fannie Mae's unavailable list, but interest rates are going to be, likely be much higher in those buildings. Terms for mortgages will likely not be able to get a 30-year mortgage in many of those buildings. And,
oh, no, wait, you have me, Orest. Of course I'll be able to get the 30-year mortgage.
So that's an excellent point, and it kind of delves into what we want to talk about today, right? There are some solutions here. Conforming mortgage financing is going to be incredibly problematic for most of the marketplace. And where is the solution, Melissa?
The solution is going with banks that are willing to finance in non-warrantable buildings, which goes to my definition of what a portfolio lender. So I believe a portfolio lender are banks that are lending off of their own portfolio and not selling loans to Fannie and Freddie. And these are not the big box banks, but the regional savings and loans, the non-bank mortgage banks, who have a robust practice of lending in these buildings and will continue to do so. Now, there are certain lenders in this non-warrantable space that offer super competitive rates, but not everyone does. And the biggest problem is really more in the conforming space. You know, with a jumbo mortgage, there have always been more alternatives. And Orest and I were discussing earlier the fact that if we go back a couple of years and when the Fannie Mae conforming limit was, $500,000, the average price of a one-bedroom apartment in New York City is $1 million. It was never a problem because everything was basically going to be a jumbo loan, especially in New York City and in many parts of Florida and elsewhere in the country. And as a result, we didn't really think about it. We were like, this is never going to be a problem. But now if you deal with what I call the big box banks who say that anything under the high balance limit, that they are not willing to finance in a non-warrantable building, and when that number is almost $1.1 million, that starts to have a lot of impact into the new condo lending, especially in buildings that are converting. Yeah. And especially another thing that's sort of like the topic that people don't talk about is that there are a large number of buildings, especially in New York City, co-ops and condos that converted, in the 70s, in the 80s, and later, where sponsors wanted to keep a large percentage of the building sort of as an annuity. When they needed the income, they would sell a unit, and it was never a big deal. But those rules have changed so dramatically, and the buildings haven't really kept up with what the requirements are. And especially since many of them, especially if you look in the boroughs where the loan amounts are all truly conforming, those buildings are going to be much harder to get financing in. And the Melissa portfolio lenders have much better rates for the jumbo. On the conforming side, the rates start to get very expensive.
Yeah. And so the end result of that is, of course, units don't sell, right? Or prices plummet, right? In those buildings that aren't compliant. I mean, we've been around long enough to see this happen before, or parts of this happen before, I should say. And that's going to be a major problem. And I think identifying that A, it's going to be a problem, and B, to have some solutions for that problem is why we're talking today.
No, and it's especially important because, while we do have banks who really just care that the borrowers are strong and that the borrowers qualify, and as long as there's no really egregious litigation in the building or an egregious structural issue, then we have banks that are willing to lend at very competitive rates. And frankly, the more expensive the apartment, the better the rates are that we can offer in any building in New York City. But when we look towards the conforming and those loan amounts, call them from $700 to $1 million, which is a big part of the marketplace at the moment in terms of, what's actively selling and available stock, it's becoming more problematic, especially if you have a buyer who's looking for maximum financing. So if you have a buyer who's looking for 90% financing, getting the mortgage insurance is almost impossible today in a building that's not Fannie Mae compliant.
Crazy. I mean, so kind of throw before we talk about new construction, because we think that's an important topic here today too. Let's just say this. The first graphic here is many condo and co-op buildings remain non-compliant. I have to tell you that, in the last year, my team and I have reviewed more buildings than we have probably in the previous decade. And we're finding more and more that I don't know how to explain it better than to say that there is so much kicking the can down the road. We have giant buildings, 200 and 300 unit condo and co-op buildings that have $150,000 in a reserve account. I mean, to mobilize any a vendor to do any sort of substantial work to a building like that is, I don't know, 10 times the amount of money they have in a reserve account. It's just an insanity on how how these buildings are really not well capitalized, and that's going to bleed into not being able to do mortgage financing in these buildings, or having a tough time doing mortgage financing in these buildings outside of Melissa Cohen. But it is going to be a tough time. But let's talk about new construction for a second, because, how does this impact new dev in New York City, in Florida, in, the large, markets across the United States? So, I mean, what we're seeing right now is that, let me give you the history. The history is you build a new construction condominium development. It's different, let's say, as an example, in New York and in Florida. In Florida, most of the time you have all of your pre-sale before you start closing on units, meaning that all the units are sold out. But in New York, as an example, when you launch the sales office in a development, in a new development, typically it takes you a couple of years to get to that 50% pre-sale mark, right? And prior to that, the history has been is that many of the big box lenders have stepped in prior to 50% pre-sale and said, we'll provide mortgage financing. And they provided what I like to call portfolio mortgage financing in those buildings. And that was primarily because the loan amounts were above the conforming limits.
It was all jumbo loans.
All jumbo loans. Now that's not necessarily true anymore, right? Now it's $1,089,000 as your loan limit, and all of a sudden those loans and those loan amounts are conforming. If they're conforming, those big box lenders are really not willing to provide that same type of portfolio approval any longer. They don't want that conforming paper. There's lots of reasons behind it. It goes back to the Dodd-Frank Act, and the creation of the non-QM mortgage. And there's lots of reasons behind why they don't want to extend that type of mortgage financing to those types of buildings at the lower pre-sales. But we're going to have an issue on new dev. And Melissa, can you get mortgage financing for new condo development prior to 50% pre-sale if the loan amount's conforming?
The answer is yes, you can. I mean, we actually have one lender, for example, who has very competitive rates, who will go to a loan amount as low as $250,000. But they require at least a 20% down, and it's only for properties that you're going to occupy either as a primary residence or a second home. We have other lenders who will do it for an investment property up to 80% with any price, but those rates at the moment are much higher. But I think that what we're also seeing, and it's not just the big box banks, but some of the larger lenders who were financing in buildings with a less than 50% pre-sale, have all decided that they want to step out of that environment, will only lend in buildings that are now at least 50% sold. And there are there are obviously plenty of condominiums in New York that are fully sold, well over 50% sold, but there are also a large number that are less than 50% sold.
Yeah, it's like the perfect storm, right? I mean, you have interest rates going up, inflation going up. Now these loan limits, everybody's like, oh, well, these loan limits are great for our building. And all of a sudden you realize why they're not, right? You realize that for some of these new developments, the loan limit increase is actually detrimental and not beneficial, correct?
Also, mortgage rates tend to be higher for conforming loan amounts than they are for jumbo loan amounts, which is another, twist in the equation.
We could talk about this all day long. So
we only have 7 minutes left.
I know. I wanted to make sure we covered the most important part, which is like the solutions, right? So, I mean, what are the solutions, right? There has to be a different lens right now. I think that's the point of this. You have to determine building-wide lending compliance. If you're a real estate agent and you have a listing in an existing or a new construction condo or cooperative building, you have to figure out whether or not that building is compliant, right, with Fannie Mae's lending guidelines, where you're going to get your lending from. And you got to do a little bit more homework. I mean, we do this all day long at CondoTek. We review and provide these condo project warrant product and out into the industry for lenders. And we review hundreds of these and thousands of these developments actually a month. But there's a couple of other steps here too, right? I mean, you got to check the unavailable list. You got to make sure that if you there is any due diligence that needs to be performed, you got to do it early, whether or not it's the day you write that listing as a real estate agent, whether or not it's, prior to the launch of the sales office on a new construction development, or sitting down with a board and saying, hey, we got to make some changes here building wide to your building. In many instances, you got to prepare purchasers for higher interest rates and
bigger down payments.
And this new dev world requires a global lending approval now. You got to look into PERS. You got to look into Fannie Mae's global approval, their global PERS approval, and you have to do some work in order to get there. That may mean changing your budget or your bylaws or your insurance policies, but you have to set up a building for success. Anything to add here on solutions, Melissa?
Yes. And I think that one thing is that when you're doing due diligence with a buyer in a building, oftentimes attorneys will have their own quote unquote questionnaire, but that questionnaire oftentimes lacks all of the bank questions that are so critically important to getting a building approved. So that's suggesting that we use like getting the Fannie Mae questionnaire completed as part of the due diligence and not just the attorney's questionnaire. Oftentimes a client will say to me, well, my attorney did a questionnaire, but that questionnaire is not going to answer the questions that relate to financing and relate to the questions about getting building approval. And Orest, we have a question in the chat, and that is, how can our viewers get a copy or check the unavailable list?
Oh, this is the worst question in the world. The unavailable list is private. Fannie Mae only delivers it to Fannie Mae seller servicer lenders, meaning that if you're not a seller servicer lender, you don't have access to it.
Well, the good news is I do, and we are.
Yeah,
so
correct.
That if you need to find out if a unit is on the unavailable list, please reach out to me or anyone on my team, and we'd be happy to let you know. And we do get that list updated to us on a weekly basis.
You jumped the gun. That's exactly what I was going to say. I was going to say, or you could call Melissa.
That's right.
Right. Oh no, our slide screwed up. Anyway, we wanted to add this slide in here, and I'm sorry it's a little wonky, but
I just wanted to take a minute, and I know that we've already touched on it today, just to talk about the fact that we do have lenders that are willing to finance pretty much in any building, as I said, as long as there's no egregious litigation. Some of the rates that we can offer are truly super competitive. Some are great rates, but your buyer has to pay a point in order to get the loan. And others, the rates are higher. But my favorite expression is that you marry the house and you date the rate. So that, we are in a period of obviously hyper rates. And that as we've seen, for example, this morning, there was this consumer price index came out showing that inflation is moderated down to 7.1%. The mortgage rates will drop next year and into the following year. So really, it's our goal to help your buyers purchase their units, get into it, get the unit closed. And hopefully, if it's a combination of obviously higher interest rates, I suspect that rates will be probably 2% lower a year from now. And that if the building gets its PERS approval, gets the reserve study, has the appropriate budgets, that they'll have the ability to refinance at a much better rate. And I always say that if you're looking to buy today in a higher rate environment, prices tend to be subdued. They may not be going up by 10 or 15% a year. And that if you can buy something at a better price and pay a few $100s more a month in the mortgage for the next year or so, in the end, you're really much better off, and buying today is the right answer.
Yeah, it's so funny. I like that saying that you just said. My saying, of course, is a little different. It comes from my dad, which is what was, and what is, right? Which is
another great saying.
So, I wanted to get to this one slide. I'm sorry, it's a little bit messed up, but there are non-QM and portfolio lenders. I think we touched on this. That you can lend without Fannie and Freddie compliance, as Melissa just outlined. And there are rate and term differences. You got to focus on that LTV because it's likely going to be lower with larger down payments.
Generally never above 80%.
Generally never above 80%.
Unless you're a doctor, of course.
Well, a smaller market. And not dependent on Fannie Mae and Freddie Mac acceptance. So there is financing out there. It's just not as easy to get. There are some resources here. Here's the link to Fannie Mae's guidelines and new loan limit increase guidelines. There's some links to Melissa and I if you like, if you need to contact us. Email, I think, works best for both of us. If you want some information on or more information outside of what we presented here today. So let me just ask this. Melissa, I can't access it. Are there any more questions there?
I don't think so. Just a question about getting copies of the unavailable list.
So we will do our best to get this presentation out to you, to everybody who's joined this presentation today. We'll obviously clean up that messed up slide.
Especially as it relates to financing.
Correct. And so Melissa, any final thoughts here today? Because I want to make sure we're on time. I want to make sure we do these 30-minute,
I just think that the message that Orest and I are trying to get across is that obviously these changes in the new Fannie Mae limits and what's happening with the new building approvals, makes it just that much more important that you utilize all the appropriate resources to make sure that you're getting the best deal. It's most important for your buyers when they reach out to a lender or ask for information that they get a yes and not a I'm not so sure, I can't finance in that building. We always want the buyer's experience to be a positive one.
It's a great point, or great points. Exactly right. I mean, echoing Melissa's comments here, look, these new lending limits are going to impact condo and co-op lending across the country. So many units are now in this conforming zone, and you have to have your solution set up for those properties because it's not all good news, right? So thank you so much for being on this presentation today. Melissa, I always enjoy every minute I get to speak to you. And thanks everybody else for joining. And we're really happy we're able to provide some key guidance here.
And thank you, Orest, for all of your incredible knowledge.
Fantastic. All right, everybody. Enjoy the rest of the day. Hopefully this was helpful. Take care. Bye-bye.
Thank you.
I'm going to shut down and leave, and I'll
Okay.